way businesses report on their taxes is changing faster than ever. At Pagero, we talk a lot about one of the most important and disruptive innovations in this space, which is continuous transaction controls, also known as CTCs. In countries with CTCs, tax authorities monitor transactions between businesses in real time, as opposed to asking for reports on them once in a while. It has changed the face of compliance totally. But does the innovation of the CTC mean the end of post-event reporting, where you file your periodic returns and wait for just the next deadline? As of a few years ago, the big question was whether e-invoicing would lead to the death of the tax return. The answer is no, it is very much alive. Tax returns are not just surviving, they are evolving. What we're seeing now is a complex coexistence of real-time and periodic controls. To help make sense of it all, let's break it down. At the heart of it all is digitalization. It is the foundation of modern compliance. The flagship digital document in the modern tax compliance era is the e-invoice. There are, of course, other types of transactional documents the governments have a growing interest in, such as orders, statuses, and transportation documents. But this one is fundamental, and it is the building block of the rest. Now, governments are taking an increasing interest in viewing and validating e-invoices. Enter continuous transaction controls. Different countries use different models, and it's important to know which CTCs are in effect in the markets that you do business in. My colleague Serlini breaks it all down in another video in this series. Please check it out if you want more information on CTC models. Moving on, we have periodic controls. These are a mix of traditional scheduled controls of old and new digital approaches, where tax-relevant information is reported on a regular basis. They are still very much in the mix and are not going anywhere. So let's get a refresher on what types there are. Indirect tax returns are reports on sales and purchases. Pre-filed tax returns, when authorities use existing transactional data from implemented CTC models to fully or partially fill in the returns. And then businesses just need to confirm. Other periodic submissions, which for instance include other VAT listings or forms of reporting cross-border sales and purchase data. E-audits add another layer, encompassing periodic controls and more. Unlike the scheduled nature of periodic controls, e-audits tend to be event-driven and triggered by tax authorities when deeper scrutiny is needed. They involve submitting detailed digital data files like the standard audit file for tax, also known as SAFT, or using centralized e-accounting systems that maintain electronic ledgers. An e-audit pulls a wide range of information on a business's activities, such as sales and purchase data, payment details, accounting balances, investments, and even inventory and stock movement. That, friends, is the entire digital controls landscape. The key takeaway in this is, while e-invoicing and CTC models are innovating compliance by adding the real-time and supply chain aspects, they are not replacing the institution of periodic controls or audits. Instead, they are evolving alongside one another by becoming more digital and more granular. Navigating this terrain isn't something businesses are meant to tackle alone. You need partners with the right technology and expertise. At Pagero, we develop the industry's leading solutions for e-invoicing, CTC compliance, and tax compliance. We ensure your document exchange and reporting comply with all relevant regulations, allowing you to focus on what your business does best and actually wants to do, which we are guessing isn't tax returns. So, don't hesitate to get in touch.